Great question, Chuck. So the way that we look at it is not so much like a mutual fund where cash is basically your dial for lowering the risk. Sometimes what we could do is increase our short exposure by owning puts, which means that you are technically long a security, but that security and that ownership in that security is only going to rise if the underlying stock is going to decrease. I'm sorry to nerd out. Please don't hate me, listeners. What I'm saying is we have more flexibility than a typical mutual fund does. And therefore, when we are feeling, let's say, bearish on stocks or not as optimistic on stocks, sometimes we'll take bearish bets, short positions, or buy puts, similar to what we discussed with the airline stocks a couple of weeks ago. But cash, the reason why I don't like cash all the time is because of inflation. Again, I sound like the broken record, but until and unless we get rewarded for being in cash or cash and cash equivalent, which is the accounting way to think of it, so something that's less than 90 days maturity, until those rates are going to beat inflation, no, we're not interested in cash. We're interested in trying to find a big gap between what the market is pricing something and what we can reasonably expect over 18 months to 36.